absolutely is going to be a huge change for the banking system. I'll give you perspectives from both when the banks are evaluating companies for giving a loan or setting up governance, etc. And second is for the banks themselves. I think where the banks need to start aligning themselves is how do they evaluate companies for the purposes of giving a loan, right, or assessing the credit worthiness of a company, because the accounting standards will essentially change the financial statement structure of some of the companies. I gave you the example of, say, real estate companies or infrastructure companies, or in a situation where you're having an embedded lease. So imagine a scenario where suppose a company has put a power plant under a government auction, right? Currently, all of that asset is sitting as a fixed asset in its balance sheet, right? The banks will fund that fixed assets, taking that information on board and saying that, okay, we are funding this project, these fixed assets are our collateral, and therefore, here are the loan terms. Under the new standards, possibly all of those fixed assets will move out and convert into either a loan receivable or an intangible asset, depending upon, predominantly a loan receivable, right? Possibly, with obviously certain conditions being there. So if that happens, then certainly on the financial statement, there'll be no fixed asset, right? So the banks will ask themselves the question that where is the collateral on the audited financial statements which we've used to finance that loan. So that understanding has to get into the banks. They need to train their staff, they need to train their people who evaluate these loan situations, and then make that right decision. I think where my concern really comes in, is that are the banks trained enough to be able to do that right assessment, or would they want to avoid some of these sectors, or they want to say that, okay, in these sectors we're going to reduce our focus because of accounting standards. Well, globally that has not happened. We hope that that doesn't happen in India, but I think that's a concern that clearly remains as one of the important aspects of how banks conduct their operations and review their operations with respect to loaning, which is their primary business, right? Second is the banks themselves, how do they get impacted by Ind-AS? And I think one of the most important aspect of this is the whole expected credit loss model. Now, which means that you record losses or expected losses on financial instruments, which is when you give a loan, you expect that loan will go bad and accordingly make provisions. That principle has changed from the previous gap, right? Though there were prudential norms which required the banks to make certain estimates of expected losses in their loan portfolios. You had the standard provision norms, and which were well defined within RBI, but those were rules. They were not principles, right? You will move to a principle based accounting for banks as well. So based on your loan portfolio, if you're, for example, historically your loan portfolio had a high default rate, typically for banks that have had huge exposure in infrastructure, real estate sectors, they've had significant, NPA scenarios or more provisions under the prudential norms of our scenario. So those will get pre-advanced into their books. So it's not that on the day one when you make a loan, you have to typically make a 0.25% approximately provision in banks' financial statements, right? That could go up significantly, because depending upon the history of losses, that could really trigger a higher percentage being recorded. What that will mean is it will create pressures on their earnings. Banks will have to essentially see how that impacts their net interest margin and therefore their profitability, which could again mean that they may again have a relook at their portfolio completely. Would they want to avoid a particular segment? Would they want to avoid how they give loans and the terms around which they give loans needs to be seen around that. And I think that's the reason to determine how the banks are going to be impacted by themselves because of these new accounting framework. But I said whenever you look at banking in India, you have to look at both in terms of how they assess the loans. So therefore, how the companies that are being given loans change their financial statements, and therefore impacts their assessment of the credit worthiness of the companies, and then also the standards impacting the banks themselves. That's how I see the banking system really moving going forward under Ind-AS.